A lot of people think fortunes are made when everything is obvious. They are wrong. Fortunes are usually made in that awkward stretch, when the facts are improving, the prices are still depressed, and most people are too frightened by the last headline to look at the next quarter. That is the stretch I want to talk about today, because software has gone through one of those stretches. Not long ago, the market treated software and AI-linked businesses as if they were the only story that mattered. Then the mood changed. Fear came in, not evidence first, fear first, and once fear gets into a market, it rarely behaves with restraint. It does not sell down to fair value and politely stop. It overshoots, it compresses multiples, it turns uncertainty into a full-blown verdict. It punishes strong businesses alongside weak ones. And then, one day, the market begins to realize it has gone too far. That is the setup I believe we are looking at now. You can see it in the way software stocks were treated over the last several months. The group was sold hard. Some names fell for the better part of the year. Some dropped far more from their highs, and yet when you looked beneath the panic, you did not see the kind of collapse in business quality that would justify the violence of the repricing. What you saw was a market that had first priced in a magnificent AI future, and then, with equal emotional excess, priced in the fear that AI would destroy the very companies that are most likely to use it to become stronger. That is a very important distinction. People like to talk about disruption as if it is a lightning bolt that only strikes incumbents. But in many industries, especially software, the incumbent is not standing in an open field waiting to be hit. The incumbent has the customer base, the incumbent has the distribution, the incumbent has the data relationships, the incumbent has the cash flow, the incumbent has the engineering budget. The incumbent has the trust of the enterprise customer who does not want a science experiment running a mission-critical business process. So before you tell me that an AI modeler is going to sweep away an Oracle or a Salesforce, I want to know one thing. What is the path, not the fantasy? The path. How long does it take to build the infrastructure? How long does it take to train the models? How long does it take to secure the enterprise contracts? How long does it take to replace workflows that are deeply embedded inside large organizations? How long does it take to go from an exciting demo to a business? A chief information officer is willing to trust with the core plumbing of a company. That path is longer than fear usually allows for. And that gap between emotional fear and operational reality is where large mispricings are born. I have spent my whole life watching the market swing between greed and fear. People imagine that the difficult part is identifying a good business. Sometimes it is, but often the more difficult part is waiting until the crowd gets emotional enough to hand you a price that gives you the odds. When that happens, the story often sounds uncomfortable. The stock has been falling. Analysts have trimmed targets. Financial television is full of debates about what could go wrong. Someone says the world changed, someone else says the old leaders are dead, and somewhere inside all that noise there is a quieter truth. The business is still there, the customers are still there, the demand is still there, the earnings power is still there, and the stock is no longer priced for any of it. That is why I think the software rebound has real substance behind it. I am not saying it will happen in a day. I am not saying it will happen in a week. Markets do not always repair themselves on your preferred schedule. This kind of recovery can take months. It can take quarters. But when valuations have been compressed for a long time, and the underlying operating outlook has not broken the way the stock chart suggests, the rebound can become much larger than most people expect, because it is not driven by one thing. It is driven by several things arriving at once. The first is that fear gets tired. The second is that earnings arrive. The third is that valuation starts to matter again. The fourth is that investors begin to remember that strong companies do not sit still while the world changes. They adapt, they spend, they buy infrastructure, they roll out tools, they deepen customer relationships, and they use the very forces that frighten the market to widen the gap between themselves and weaker competitors. That, to me, is the central idea here. Last year, the market bid up software because it could see a robust AI outlook. Then the market turned around and sold software because it became frightened that AI itself would become the thing that destroyed these businesses. But the more I look at the situation, the less convincing that second story becomes. It is certainly possible that some businesses will be disrupted. It always is. The market is not wrong to ask the question, but it is asking it in a way that has treated all software as if it were equally fragile. And that is almost never true. There is a big difference between a business that is already woven into the infrastructure of the enterprise and a business that is still trying to prove it belongs there. There is a big difference between a company and scale and a company with only excitement. There is a big difference between a business that can fund its own adaptation and a business that must survive long enough to discover a viable model. When the market ignores those differences, opportunities appear. And I think you can see that most clearly in the three names that define this setup in different ways. Oracle is the first one. Oracle is important not only because of its own business, but because it acted like a signal flare for the whole group. The stock jumped sharply, more than 10% in a single move, without one neat headline that made the story simple. That matters. When a stock does that after a long decline, what it often tells you is that there was demand waiting below the surface. Buyers were not absent. They were cautious. They were waiting for the tape to turn. Then one move triggered another, and suddenly you had a buy signal the whole market could see. Now if you stop there, you miss the real point. The real point is not that Oracle bounced. The real point is why it was so depressed in the first place. The market originally loved Oracle because it could see the revenue growth potential attached to AI demand and infrastructure build-out. Then sentiment soured because Oracle took on debt to fund the data center and infrastructure expansion required to meet that demand. In other words, the same story that got people excited about the opportunity later frightened them when the bill for building it came due. That is classic market behavior. The market loves future growth until the spending required to secure that future growth shows up on the balance sheet. Then it suddenly behaves as if investment were a character flaw. But here is what I care about. Is the debt growing faster than the opportunity, or is the opportunity growing faster than the debt? That is the only question that matters. And the evidence here points in one direction. The backlog growth has been running at a much faster pace than the debt growth. The backlog is not the whole story either. It is only the visible contracted piece of the story. It does not capture all of the long tail revenue that can come from the infrastructure once it is built. So when I hear people say that Oracle is taking on too much debt, I do not dismiss the concern. I simply place it next to the other side of the ledger. And when I do that, the picture looks much more constructive than the stock chart made it appear. The stock had a huge run, then a huge pullback. It started falling before much of the rest of software did. It has a lot of ground to regain. That is exactly why the setup matters. When a strong business has fallen hard and the operational story remains intact. The upside does not need perfection. It often only needs the absence of panic. Even the analyst community, after all the reductions and all the nervousness, still points to substantial upside from those depressed levels. And when analysts become cautious without actually turning bearish on the business, that often tells you the sentiment wound is deeper than the fundamental wound. I have seen that movie many times. The second name is Salesforce. Now this one is especially instructive because it shows you what happens when the market becomes almost willfully uninterested in evidence. Salesforce has been positioned for AI and agentic AI in ways that matter to actual businesses. It has been expanding penetration. It has been showing productivity gains. Analysts coming away from technology events have seen signs that the company is not merely talking about utility, but demonstrating it. The company has itself pointed to a path back toward faster growth. In a sense, that would matter a great deal. But markets are not always sane in the short run. A company can beat expectations and still see its stock keep tumbling if the mood of the market has already decided it wants out. That is what happened here. The numbers did not justify the violence of the selling. The mood did, and when mood drives the stock far enough away from the business, valuation begins to do very interesting things. Salesforce got dragged down to a level where it was trading at an earnings multiple far below the range investors had historically been willing to pay. That is not a small detail. That is the whole game. When a company with durable enterprise relevance, cash generation, and demonstrated utility is suddenly treated as if its future has permanently dimmed, you have to ask whether the market is pricing a real deterioration or simply pricing fear. Then add another fact. The company launched an accelerated share repurchase program of extraordinary size, $25 billion. I want you to understand what that means when paired with a depressed stock price. A buyback is not magic. It does not repair a weak business. But when a strong business reduces share count aggressively while the stock is compressed, it increases the leverage existing owners have on the eventual recovery. If the company merely holds its ground operationally and the market stops panicking, the earnings and cash flow are spread over fewer shares. That is how an upswing gains force. So while the market was busy asking whether AI might someday threaten Salesforce, Salesforce was doing what strong operators do. It kept serving clients. It kept proving utility. It kept building. It kept using capital allocation in a way that can reward the patient shareholder once sentiment turns. And here is the overlooked part of the disruption argument. Even if you believe that the future will become more competitive, that does not tell you the incumbent loses. In fact, when there is a period of intense technological change, the businesses that already sit close to the customer often get more chances to monetize the change than outsiders do. They do not need to convince the entire market to trust them from scratch. They need to deepen the relationship they already have. That is a very different task. Now we come to the most speculative of the three, SoundHound. I think it is important to separate this one from the first two because investors make bad decisions when they flatten everything into one category. Oracle and Salesforce are established enterprise businesses with scale, deep customer relationships, and mature economics. SoundHound is a more emergent story. It has been burning cash. The stock has been punished hard. It has hurt people. Anybody who bought it at the wrong time has felt that pain. And that matters because when a stock keeps falling, investors often stop distinguishing between temporary pressure and permanent impairment. That is when discipline matters most. With a speculative business, you do not get the luxury of pretending risk is low. It is not low. You do not get to ignore money management. You do not get to fall in love with the story and marry the stock. You watch the news flow, you watch the operating traction, you watch the path to profitability. You control downside. You take gains when they are there. You recognize that large swings come with the territory, but acknowledging that does not mean there is no opportunity. The reason this name remains interesting is that the business has continued to show signs of expansion in client penetration and validation of its technology. The recent development with Qualys matters because it suggests a move from testing toward fuller deployment that changes the tone of the revenue outlook. It does not eliminate uncertainty, but it gives the market something concrete to evaluate beyond aspiration. Analysts, even after lowering targets, still see meaningful upside from these levels. Institutions have been buyers. That does not guarantee success. But it tells you the stock is not being abandoned by every informed participant. Still, the decisive issue is clear. This company needs a cleaner path to profitability. The market can forgive many things, but it does not forgive indefinite murkiness forever. Revenue growth must strengthen. Margins must improve. Costs must be controlled. The story has to move from possibility to visible operating leverage. That is what would change the stock. And that is why I think it belongs in this conversation, but in a different bucket from Oracle and Salesforce. It is not the same kind of opportunity. It is a higher risk, less proven expression of the same broad thesis that software was sold too hard and that the market can overpunish the businesses. It does not yet know how to value correctly in a fast-changing technological cycle. The reason I like studying all three together is that they reveal the shape of the rebound. Oracle tells you about scale, infrastructure, and backlog versus debt. Salesforce tells you about durable enterprise utility, compressed valuation, and the power of buybacks when fear has done the damage. SoundHound tells you about the speculative edge of the theme, where the market requires not just growth, but proof that growth can become a real business with real profits. When you put them together, you begin to see that the software rebound is not just one trade. It is a repricing process. That process usually unfolds in stages. First, the strongest names stop going down. Then the market notices that the results did not collapse. Then the fear narrative weakens. Then the earnings reports begin to provide catalysts. Then analysts stop cutting and begin raising. Then retail money comes back. Then the crowd that said the sector was untouchable starts asking if it missed the bottom. By the time that question becomes fashionable, a good part of the easy money is often already made. That is why I do not spend much time obsessing over the exact bottom. People who worship precision often miss the larger opportunity. If a stock has been hit hard, if the valuation is depressed, if the operational story is intact, If the company is using the changing environment to strengthen itself rather than being broken by it, and if the recovery likely unfolds over months or quarters, you do not need to catch the first dollar to do very well. You need to recognize that the asymmetry has changed. That is what I think has happened here. A lot of investors are still asking the wrong question. They are asking whether software is safe. That is not the right question. The right question is whether the market has over-discounted risk relative to the actual earning power and adaptive capacity of these businesses. If the answer is yes, then the rebound can be large precisely because the sector was left for dead in sentiment long before it was left for dead in reality. And there is another thing worth saying plainly. The backdrop matters, but it is not the main story. Yes, broader market relief can help. Yes, positive developments around geopolitical tensions can make investors less defensive. Yes, earnings season can focus the market's attention. All of that matters. But durable recoveries in a sector do not happen simply because one week feels better than the last. They happen when the market discovers that the worst story it told itself was too dramatic. That is the opportunity here. The worst story the market told itself was that AI would come for software before software could use AI to become more valuable. I think that is backwards. I think the likely reality is that the established companies most people use, the ones with customer relationships, infrastructure, and capital, will use these tools to boost their businesses more effectively than outsiders can use them to displace those businesses in the near term. Over a long enough time horizon, there will be winners and losers, there always are. But the market sold this group as if disruption were immediate, total, and evenly distributed. That is not analysis. That is exaggeration, and exaggeration creates bargains. Now, I want to be fair. This does not mean risk is gone. It does not mean every software stock recovers. It does not mean all the spending on AI infrastructure will automatically justify itself. It does not mean speculative names deserve blind faith. It means the relationship between price and reality has improved for the patient buyer. That is a very different claim and a much more useful one. Investing is not about demanding certainty where certainty does not exist. It is about comparing probabilities with price. It is about recognizing when expectations have become too low or too high. It is about understanding that the market is a voting machine in the short term and a weighing machine in the long term. And when fear drives the voting machine too far from the scale, you can make very good money waiting for the scale to matter again. That is how early investors make fortunes, not by buying stories at peak excitement, by buying durable or improving businesses after the excitement has washed out of the price, but before the improvement has fully returned to the narrative. That is a harder thing to do emotionally, which is why it pays. Anybody can feel good buying a stock when it is loved. The skill is being able to buy when the numbers matter more than the mood. I think Oracle represents that. I think Salesforce represents that even more clearly. And I think SoundHound, while far more speculative, represents the outer edge of that same opportunity for those who understand that speculation requires discipline, position sizing, and a willingness to demand proof. If I were looking at this sector today, I would not ask whether the rebound has already moved a little. That is too small a question. I would ask whether the repricing process has truly finished. I would ask whether the businesses are getting stronger or merely looking cheaper. I would ask whether the market's prior fear was supported by evidence or just by the speed with which sentiment can spread. And then I would ask the only question that matters in the end: am I buying a fading story, or am I buying a business whose price was dragged down by fear faster than its economics were damaged? That question separates speculation from investment. If the answer is that the economics remain sound and the fear was overdone, then the rebound is not the story. The rebound is only the first chapter. The real story is the distance between where these businesses are priced in despair and where they may be priced once earnings, cash flow, and reality begin to speak louder than fear. That distance is where fortunes are made, and when the market gives you that distance, your job is not to be impressed by the drama of the sell-off. Your job is to measure it, to think, to separate mood from math, to distinguish the strong from the weak, to pay a sensible price for businesses that can still earn, still adapt, and still compound, because the market will always find a new reason to panic. But if you learn how to recognize when panic has outrun the facts, you do not need to chase the crowd. You can let the crowd do the emotional work for you. Then you step in when the odds are finally on your side. That is how fortunes are made. And I suspect this is one of those moments when the patient investor, not the excited one, will be rewarded.